A stop-loss order is a trading tool used to limit potential losses on an investment. By placing a stop-loss order, a trader instructs their broker to sell a security when it reaches a certain price, known as the stop price. This helps mitigate losses, especially in volatile markets where prices can fluctuate rapidly. For instance, imagine you purchase shares of company XYZ at $50 each. To protect your investment, you set a stop-loss order at $45. If the stock price falls to $45, your broker will automatically sell your shares to prevent further losses. This means your maximum loss is capped at $5 per share, providing a clear exit strategy. However, it's important to note that stop-loss orders don't guarantee an exact price execution. They are executed at the next available market price after the stop price is hit. In rapidly declining markets, this could result in selling at a lower price than expected, known as slippage. Additionally, using stop-loss orders can provide peace of mind, allowing traders to step away from their screens without fearing catastrophic losses. Overall, stop-loss orders are a fundamental strategy for risk management in trading, helping investors maintain control over their portfolios.